Backtesting is the trader's version of athlete's practice. You have to spend hours in the charts to improve your trading ability, to hone your skills, and to make you a more profitable trader. The same way that an athlete spends hours in the gym getting stronger, getting fitter, improving their ability, and making them a better athlete. What is going on, guys? It's Thomas here, and today we'll be discussing what is backtesting and how to backtest your trading strategies. So in my opinion, backtesting is the most important part of your trading journey. Backtesting allows you to test a strategy using historical data and understand the profitability of that trading strategy and whether you want to trade your live money using that strategy. Not only does backtesting help you to understand the profitability of the trading strategy, but it also helps to improve what's called your reticular activating system. So your RAS assists in being able to pick up trading entries and to see your trading entries easier, and by spending the hours backtesting and continuing to find trading entries, when it comes to live trading, this will become more effortless for you. Now, backtesting may not be the most enjoyable part of becoming a professional trader. However, it is the most important to ensure your profitability and to understand exactly how to trade your trading strategy in the live markets. So backtesting involves going through historical data and identifying your trades and collecting this data to be able to use ratios to understand the profitability of that trading strategy. So when backtesting, you would record the data, and there you'd be able to analyze the profitability and the expectancy and the drawdowns within that trading strategy. Now, obviously it's not live data and you're not putting live money on the line. However, it's great practice to be able to understand how the strategy runs and whether it is something that you would want to take over to your live trading. So just like a professional athlete, you are going to have to spend hours backtesting. I've probably spent over 100 hours myself going through past data, testing different strategies, changing those strategies to make sure that they have the most profitability I'm able to receive out of those particular strategies. Now, it isn't fun. The first couple of hours may seem fun when you first get into your trading journey. However, unfortunately, after a while, the fun will run out. Just like an athlete's practice, you've just got to continue to stick to it and improve your trading abilities through your backtesting. And when it comes to live trading, you want to ensure that you do remove the emotions from trading. So it will the fun of trading will eventually wear out. It is still fun, but you just want to make sure that your trades that you do take aren't involved emotionally. You want to remove your emotions from the trading and make sure that you are just following your rules within your trading system. And backtesting is extremely helpful in doing this, as you're improving your reticular activating system, you'll be able to see trade entries easier. When it comes to live trading, you'll be able to remove the emotion from it, and by being able to see your trading entries easier as you've spent hours practicing the strategy using past data, this will help to remove the emotions and to make sure you're involved in the trades, which you should be. So backtesting is pretty simple. All you need is an Excel spreadsheet and a data source. So depending on where you're obviously learning your trading education, most trading education platforms will have some sort of template for backtesting. But if you are creating your own backtesting spreadsheet, the data which I would recommend that you collect is your entry date, entry time, entry point, exit point, total profit or loss. Now, unfortunately, I can't be recommending my own. I have got a couple of links below to some that I've used previously. I'm no Excel whiz, so I haven't even bothered creating my own. I'll leave that to the professionals and people who've spent the time to create these spreadsheets. So yeah, head below if you do want to have a look at a couple of different options, which I have used personally for my backtesting. And I do take no credit for this. I've linked below the source which I've got it from. Now, when it comes to finding a data source, there's multiple options out there. Typically recommend going through your broker. If you sign up with a demo account with a particular broker, they'll typically provide a historical data source. In my opinion, the best way to find your data is going through TradingView. Again, I've linked this below. If you want to sign up for their professional account, they now are able to offer 20,000 bars of historical data. Now, TradingView is an online charting platform. Now, in my opinion, it is the best charting software available. There are other options as well. NinjaTrader is a great option. MetaTrader is another free option, but TradingView is now linked with a lot more brokers. It's very seamless. There's a lot more options when it comes to charting, and when it comes to backtesting as well, they have their own little systems where you can go by bar by bar to go through historical data just to make sure that your data is accurate and you are getting involved in trades which are winners and losers. It is hard when it comes to backtesting, and I will go through it later in the charts how to do so, because if you are just flicking through a bunch of data, your eyes will be typically drawn to only the winners. However, if you go bar by bar, which I would recommend, so go all the way back through your historical data and start ticking through bar by bar, and that way you're emulating what it would be if you were trading live. And you'll find that if you do it this way, from my own experience, you'll find a lot more losers than you would if you're just flicking through data. And this is because your eyes will be drawn to those profitable trades more than it is to the negative trades, especially when you start backtesting as well. All right, now in regards to how much data you should be collecting, I typically would recommend going through 5 years of data or finding 50 trades for each trading strategy you'll be trading on every trading pair. So once you outline what pairs you'd like to be involved in, go through each pair individually and find at least 50 trades, or go through 5 years of data for each trading strategy on that pair. Now this may seem like a lot of data, however you want to ensure that you're collecting as much trading data as possible to understand the exact performance of that strategy and the profitability over a select period of time. So once you've collected this data, the main parts which you want to understand is obviously your total pip count, your return per year, so you want to understand the return of that trading strategy on each individual pair as well as the strategy as a whole. You also want to understand your maximum drawdown. So your maximum drawdown is defined as the drop between your highest high and your low after that high. So the decrease in your trading results over time. So for example, if your trading results were going up and it hit 10% and then it dropped from 10% to 5%, then your maximum drawdown would be 5%. Now this number is extremely important because it helps you to understand that when you are in a drawdown, how much has your system shown drawdowns in the past. Now when you are losing trades consistently, it does have an effect on your emotions, and your emotions will come into play. But if you do understand the maximum drawdown and the most loss which your trading strategy has had, you can use this data to create confidence and to make sure that you understand that you may be losing a lot of trades, however your trading strategy has shown X amount of loss over time. Therefore, you still need to make sure you consistently trade that strategy, as you're not at your maximum drawdown and it's just a drawdown within the system. Now, not every trade is going to be a win, obviously, and you are going to hit drawdowns. So by being able to backtest and being able to understand your maximum drawdown which you've hit, that will help you to create confidence in that trading strategy. Now, if you do hit that maximum drawdown, then that's when you need to start to have a look at the trades which you've been involved in and make sure that these trades are what you had tested in your past, whether they follow the same rules as the trades in your backtesting. And obviously if they haven't, then this is going to have an effect on your numbers when it comes to live trading. But if they have been the same, then potentially the data which you've collected isn't as accurate as what the live data and your live trading is showing. And the last piece of important data is to calculate your trading expectancy. So your trading expectancy is basically an overall summary of what's the expectancy of that trading portfolio. And to calculate this, you would multiply your win percentage by your average win in pips and subtract that by your loss percentage and your average loss in pips. Now, if this is a positive number, then the expectancy of your trading strategy is positive and you will be making money over time. However, if it's negative, then the strategy which you've tested isn't going to be profitable over time. Now, when it comes to trading, it's basically like a casino, except you are the casino rather than the gambler. So over time, your expectancy is going to be profitable. You don't know exactly when the profits will come, but this ratio shows that over time, if you continue to trade that strategy, you're going to have a positive expectancy and the trading strategy will be profitable. This also shows the lack of importance of your actual win percentage. So you can have a massive win percentage, but if your losses massively outweigh your wins, then your expectancy is going to be negative and you aren't going to be making money on that strategy. And on the flip of that, if your win percentage is around 30%, but your wins are 5 times larger than your losses, then you're going to have a positive expectancy. You'll be taking more losing trades. However, your trading strategy will be profitable over time. Now, if you do go and backtest a strategy and then you find it does have a negative expectancy, then you have to look at the actual trading style and the strategy and understand whether there's something you could tweak to potentially make it profitable, or whether the strategy in itself isn't going to be profitable for you. Now, it is a bad feeling when you spend hours and hours back testing the strategy and then you do find out, unfortunately, it isn't a winning strategy. It's happened to me multiple times. However, it's just like any business owner. If they go and try and start a business and then the business isn't profitable, you need to cut your losses. Don't go and try and trade the strategy live, because you already know that it's not going to have a positive expectancy. And on top of this, you need to trade every pair like an individual stock. So a particular strategy that you're testing may not actually be profitable on every single pair. So I trade 26 pairs in my portfolio. However, I don't trade every strategy for all of the 26 pairs. There's different strategies which I trade for different pairs. Each pair will move differently. They have their own personalities, just like any typical stock. So if you do find that your strategy is only profitable for 5 out of the 10 pairs that you're trading, doesn't mean that you have to negate the strategy. Potentially you could look at taking the strategy on to your trading portfolio, but only trade those 5 pairs which it's profitable on. Alright guys, so now we head over to the charts. I'll show you exactly how to backtest, and I'll also show you a couple of different options in regards to spreadsheets and how to collect your data. Alrighty guys, so now we're over on the charts, over on TradingView, which is the platform that I would recommend most people to do their backtesting. I just want to go through an example of how to backtest and how it works. So we're over here on the Aussie dollar. I'll just go out to my typical trading time frame, which is the 4-hour chart. Just ignore any lines and everything on the chart at the moment, just a couple of things that I'm looking at. But TradingView have this awesome tool called the replay. So if we go through some past data, we'll start here and click the replay button, and we basically draw a line of where we want to start. And then what we'll see is that it will actually tick through bar by bar from that line, and you'll be able to get involved in trades as you go through. So you can see it here, it's all going here, bar by bar. And this is what I'd recommend the best way of going through. You can use the ticker tool, or you can just go through. We'll exit that, and we will just start from here. You can basically just go through and use your arrow tool just to go through bar by bar and tick through the trades. This would be the best way I'd recommend to go through and backtest. So once you've found the trading entry, so I'll just quickly go through and find one for you guys. Alrighty guys, so I found a trading example. The rules of the trading strategy don't matter too much. It's more just the structure of how to backtest. So I found my trading entry here. It's this red candle, just where my stop loss is here. That's my stop loss, and my targets are down to previous lows down here. But yeah, so that would be an example of a trading entry for me. So I'd go over to my spreadsheet, I'd put down the date, which is the 6th of February this year, the time, the entry's point, and then I'd go through where the trade ends, which would be here, and allocate the time which the trade was closed, the date which was closed, and then the price which was closed. And from there I could use the entry price and the exit price to be able to find the total pips of that trade. And then you just go through previous data to find either 50 trades or 5 years worth of data, and this will give you an adequate amount of data to use to understand the profitability and to touch on those ratios which I discussed earlier. And I also just wanted to bring up an example of a backtesting data sheet. So this is an Excel spreadsheet which I use for one of my backtesting strategies, but basically to show you what it is. So obviously everything's different. I will be providing this one down below. This one is free. I can provide the link to this one, but this just shows you an example of how much much data some people do go towards their backtesting. Like I said, the main things for me, done here, go back. The main things for me are your entry point, your entry date and time, and then your exit point and your exit date and time. And with that data, you'll be able to understand the profitability of the strategy. You can kind of, in this one, you can see they've gone into pretty in-depth detail in regards to gross profit, net profit, absolute drawdown, maximum drawdown. You've got your annualized returns, your profit factor, which is the expectancy that I discussed earlier, and it has a graph here just to explain the equity curve as well. But yeah, so I would recommend to find a backtesting spreadsheet. If you don't want to create one yourself, your trading provider should be able to show you an example of a backtesting spreadsheet as well. So backtesting is extremely important to understanding the profitability of your strategy. It may not be the most fun part of trading, however, in my opinion, it is the most crucial part to ensure your profitability over time of your trading strategies. Just like a professional athlete, you have to make sure you put in the hours in practice, you continue to improve your skills and improve your reticular activating system so that when it does come to live trading, your trades are going to be emotionless and they're going to be seamless and you will become a better trader. So that's it guys, thank you so much for tuning in. If you do have any questions regarding backtesting, please feel free to leave a comment below. Otherwise, if you did enjoy the video, please feel free to smash that like button. Make sure you subscribe to keep updated with future videos. Thank you again for tuning in and I really look forward to seeing you next time.